it's amazing how quickly this story has changed. I mean, to think that it was trading sub $30 a barrel, now it's closer to $48.50 right now. It's all about short-term supply. I mean, overall, the market's still in oversupply, but right now we're going to go severely from contango to maybe a backward market pretty quickly if the supply disruption continues. And you mentioned both Nigeria and Canada. We're also seeing some tight supplies in North Sea oil. So it's going to be really interesting to see. I mean, I do believe the risk of it retracing is much higher than the risk of it going higher in the next month or so. I still do believe that oil can touch below $40 a barrel between now and the end of the year. But all that to say, we should end up in a balanced market at the end of the year. So the volatility could actually increase short term, but I think over time it's going to decrease, ending up where it started right now today.
Yeah, it's been one of the big stories, I suppose, dominating markets recently. Today as well, we've been hearing out from a lot of Fed speakers again, and I'm just going to go through those. Fed officials saying that 2 to 3 US rate hikes are possible this year. Atlanta President Dennis Lockhart, June is live, and 6 weeks later we meet again. San Francisco Fed President John Williams speaking with Lockhart at a joint appearance in Chicago. 2 to 3 hikes this year seems reasonable. I think incoming data have actually been quite good and reassuring. Both officials said markets were not giving enough weight to the possibility of a rate hike in June. So, Larry, what is your take on these comments? Because hearing more and more each day, but they did seem to be pretty hawkish, and off the back of that, markets really did respond.
Yeah, I mean, it just goes along what we've been talking about almost every week since the beginning of the year, and that's the market is just not ready for more rate hikes. Somehow they think this emergency measure put in place by the Federal Reserve is somehow going to go to perpetuity or until the economic conditions are perfect. We're never going to see perfect conditions. We're going to see conditions that are good enough. We have to remember this was considered emergency, and so now that we're seeing the right numbers in the right spot, it makes a lot of sense. And I've said all along that I believe 2 to 3 rate hikes this year is a reality. And the market, you can see what happened today. We had 2 really good solid numbers in the U.S., but yet the market just shrugged its shoulders, really nervous in the fact that maybe June or July we're going to see a rate hike. And I do believe it's going to come to fruition.
So is this sort of one of the main risks to markets going forward? Because today we've been talking about these markets sort of remaining range-bound. They seem to be sort of stuck in no man's land at the moment. I suppose they're waiting for this next big catalyst. Is the Fed a big risk going forward?
I do believe it's a short-term risk because I just don't think the market is ready for it. I think intermediate or long-term, the fact that the Fed is raising rates is a good thing. It means our economy is healthy and deserves to go in that direction. But short term, the market is flat-footed, and I just think we're going to see a lot more consolidation as this becomes a reality. And let's keep in mind that the S&P 500 is not only unchanged from yesterday, it's unchanged basically for 2016, and it's trading precisely in the same place it was in November of 2014. So 18 months of basically doing nothing.
Just on the market, because we've seen that pullback today, although to some degree sort of just in a neutral position because we gave back pretty much all of yesterday's gains. If we look at the S&P 500, though, we saw it obviously suffering back in August. We saw it suffering at the beginning of the year, January and February. Do you think we're heading into the same sort of pattern now where we could see a similar situation, a similar maybe sell-off in those markets again?
Yeah, that's a great question. I absolutely do not see that happening again. And one of the reasons is that corporate America is doing well. The last earnings season was far from robust. It was far from great, but it was definitely good enough. And it put consensus back into the mode that, okay, we deserve to be about $123 a share for the S&P 500. Looking forward to $130 a share next year. Keep in mind the depths of the debacle in January, people were penciling $115. So that's a big difference. Also in China, that's a big one. They've been a lot more transparent with policy announcement and telegraphing that. The right numbers in China are going in the right direction. FX outflows, inflation numbers have been good. I'm not saying all other numbers are good, but that's clearly not true. But the right numbers are in the right place. Also with China is that sentiment is so bearish right now that I think it's almost a foregone conclusion that things will continue to go better there, just the fact that people are so bearish about it all. So I don't see us going into a debacle like we had this past January, not in the least.
You mentioned there corporate America sort of performing better than expected, and we're very much coming to the tail end, I suppose, of a reporting season. What do valuations look like at the moment? Are they looking a little bit stretched, and how does that make the S&P sort of appealing or unappealing?
That's a funny question, because is $123 a share stretched? And you really need to compare that to history. If you just look at it as a number, I would say, yeah, it's not overly stretched, but definitely on the right side of being stretched. I think the right way to look at that number is more on a relative basis. Relative to what? I mean, is a 1 3/4% return on a 10-year yield, is that stretched? Is that too low? So I think it's all just relative. I'm a little bit uncomfortable with $123 a share, but a lot more comfortable than when it was trading up around $130 a share.
I suppose one of the other considerations is around the dollar as well, isn't it? Because investors do seem to be starting to pare back on some of that negativity around the dollar. Do you think it's got some room now to move higher?
I do. I do. I mean, on a trade-weighted basis, it was down about 6% this year. It's rallied back a little bit from that point. But, the U.S. numbers, the numbers everybody's been waiting to get better, finally have gotten better. The retail numbers, consumer, the spending, services number, the number today with inflation, it was the biggest increase we've seen in a very, very long time. So I think the momentum is going to go back into the U.S. dollar against certain currencies, given the fact that we're growing at a faster rate than the other countries are.